Hello, everyone. Tony Warfield here. Today, we get to talk about term life insurance explained. This is an opportunity for me to be able to help break down the intricacies of term life insurance. Now, when I say intricacies, I'm not looking at trying to break down each and every different situation because each and every situation can be very, very, very different from person to person. But I definitely want to be able to give you the information to help you understand the importance of term life insurance or insurance in general, and also how it can apply to you and your family. So let's go ahead and get started. There are basically two types of insurance. There's term that we discussed, and we also have permanent. We will be covering term in this presentation. However, I just wanted you to just get a good understanding of the various types of insurance that are out there. Of course, term life insurance, permanent life insurance, whole life insurance, universal life insurance, also indexed universal life insurance, variable life insurance, variable universal life insurance, simplified issue life insurance, guaranteed issue life insurance, final expense insurance, which many of you may be aware of, and then of course group life insurance, which if you are an employee of any company, you probably are aware of that as well. So let's get a little bit further along. So what is term life insurance? If you need life insurance, term life insurance is a great value for most people looking for it. Term is a very easy to understand, affordable, and is basically pure insurance. It's a lot like your auto insurance. You pay to protect your car if something happens to it. Term life insurance is paid just in case something happens to you. Term life policy coverage periods, they vary. As you can see here, you can do a yearly, 5 year, 10, 15, 20, 25, 30. However, most of them are usually between 20 and 30 years. So the features of your term life insurance, as I stated, your set period is usually between 20 and 30 years. It's very affordable. Your monthly coffee budget could cover the cost of $250,000 of coverage to protect you and your family. So how awesome is that? You don't generate any cash value. The cost of insurance is all you're covering. You pay a small premium depending on your health. If you're a smoker, non-smoker, if you have diabetes, or you might have a pre-existing condition, but that's not going to do, that doesn't always disqualify you. So it's something that the insurance company have to take a look at. Most of the time, you have to get a health examination. So if you have a pre-existing condition, you want to make sure you tell your agent, because you want your agent to have as much information as possible to convey to the insurance companies, because what happens is as they review your application, if they find that there was some information that was less than true, you might not be denied coverage. So you might want to just make sure you tell them everything up front. It's a great choice for people looking to replace their income. You usually want to get about 10 to 12 times your annual salary. Let me give you a little bit of understanding why that's important. If you're the primary breadwinner in your family, you got a couple of kids, you got a wife if you're a guy, or you got a stay-at-home husband if you're a young lady, and something were to happen to you, you would want to still be able to provide for your family. You want your family to be covered at least long enough for your significant other or for the children to be able to recover from the loss of your yearly income. Now, of course, they're going to take a long time to recover, if ever, from losing you, but they still have to live. So getting about 10 to 12 years is about the right amount of coverage that you need to make sure that your family can maintain a certain lifestyle while you have transitioned. And it's great for debt payoff. We generate some debt. When we get out of high school, we go to college, and wow, we generate a lot of debt. We don't have enough money to be able to afford things. So you get your financial aid, and you get your different loans to be able to help you fund your education if you decided to go to college. So, a lot of the debt that you accrue, whether it be for cars or mortgage, this policy can help you cover a lot of that. Different types of policies do different things, and you want to make sure that your policy covers your specific situation. Business policies or key person insurance. If you have a partner who's critical to the operation of your business and something were to happen to that partner, then that would actually hurt your business. So key person insurance, if something were to happen to that partner and that partner were to transition, then your insurance policy would cover that loss financially. So there are a couple of drawbacks to having term life insurance. First of all, it's costly to renew. As a policy has a higher chance of being paid out, the older you get, the premium can increase, and it can be pretty steep. I don't want to tell you what the number could possibly be, but it could be in the thousands. It could be very significant. The insurance coverage ends at the end of the term. I want to say that and be clear. The insurance coverage ends at the end of the term. No coverage once the policy coverage period is over. Younger people want to consider this most as they are healthy and may need a different form of insurance. This is important because I believe everyone should have insurance. Some people might argue that, hey, I don't have any family, I don't have anybody to look after, but you might have a charity you might be interested in, you might have a family friend, or there might be someone that you might see on your porch every morning that you want to that you want to take care of if you were to transition. So, I think insurance is important. And that being said, if you're young and you get a term for 30 years, say you get a term for at year 20 and you get a term for 30, by the time you hit 50, you're still young, but the premiums are going to be considerably higher. So you might want to consider a permanent policy as well, or in addition to your term policy, depending on your age. That's just my opinion. The premiums are complete at the end of the term period. If you outlive your policy, your payments are forfeit. So there are other options. And so when you think about your payments being forfeit, if you're paying $40 a month for 20, 30 years, that's a pretty good chunk of money at the end of that 30-year period. But that money is still forfeit if you're still alive. But there are things that you can do about that. So renewable versus convertible term. The good news is that most term life insurance policies are convertible. So you can change it to a permanent life insurance policy at any point during the term or before the age limit as set in your policy, whichever comes first. However, the death benefit face value will no doubt be less. So if you have about $500,000 in coverage, depending on your age, when you're getting close to the end of your term, or whenever you decide you want to convert it, they'll do a calculation and determine exactly what your new death benefit will be for the amount of premium that you'll be paying. So that is something that has to be worked out between you and the insurance company. Okay. And you can renew most term insurance policies for one or more terms, even if your health has changed. Each time you renew the policy for a new term, the premiums may be higher. That's what the premiums will be to continue your term policy, because if you can't afford the new policy terms, then you might want to consider getting a different policy instead of renewing it. And that's something that you would have to work out with your agent, so you'll be able to get what's best for you, not for your agent. And one quick disclaimer, I am a licensed insurance agent. I really want people to understand the importance of this. As a licensed insurance agent, my job is to help you get what's best for you, not what's best for me. So it is in my best interest that my customers, my clients, my family, my friends get what's best for them, because that way I know that I've done a good service for the people that I care for. Mm. Okay, so the types of terms discussed. There are about three that I want to talk about today. The first one, obviously, is your standard term that we've basically been talking about. It is insurance that pays a benefit in the event of the death of an insured during a specified term. We understand that. However, there are a couple of more that I want to talk about. So you have group life insurance. This is a type of insurance in which a single contract covers an entire group of people. Typically, the policy owner is an employer or an entity such as a labor organization, and the policy covers the employees or members of the group. Term insurance is the most common form of group life insurance. And as an employee with your insurance, you might pay just a few dollars coming out of your paycheck, but you might have noticed that you never get a medical examination for a group life insurance. The reason why that happens is actuarially they're determining the best and worst case scenario with the group of people in your employment organization. Okay, so they give you the average cost of that insurance. Now, depending on the average age of the employees or the average health condition, they work all that out. That is how the pricing for your group life insurance is determined. Now, in addition, as with most group life insurance policies, if you no longer work for that company, you no longer have that insurance. So you want to make sure that, hey, if you're going to be there for 20, 30, 40 years, that's great. But a lot of young people, they're having jobs anywhere from 2 to 3 years, and they're moving on to bigger and better things, which is great if they continue to get the life insurance depending on where they're working. Excuse me. But you can't take it with you. So as you go from one job to the next, if you don't have insurance to cover you as you're in between jobs and something happens, then that could be very devastating to you and your family. Of course, we have final expense insurance. It's designed to cover the bills that your loved ones will face after you die. These costs will include medical bills and funeral expenses. Final expense insurance is also known as burial insurance. Now, this might be something interesting to you. Um, Minorities tend to have more insurance policies than others. However, minorities' average insurance policy is less than $100,000. So we're not really taking advantage of the power of what insurance can do for us in terms of legacy building. And that's because, like the name of my group here, they didn't tell us, because they didn't tell us. So your final expense insurance is just looking at taking care of your burial costs for a family, but there's still other things that have to happen. Once you bury your father, or once you bury your cousin, or once you bury your family member or significant other, you still have to live. And if they were the primary breadwinner, you're going to need additional monies to be able to cover you and your family. So, that being said, term life accelerated benefits. At no cost, your term policy could have an accelerated benefits rider added to your policy. Three types will be discussed. You have the accelerated benefit rider for terminal illness. This is for an eligible insured person diagnosed with an illness or chronic condition that is expected to result in death within 12 to 24 months. This may vary depending on the state you reside. You also have accelerated benefit rider for chronic illness. An eligible insured unable to perform 2 out of 6 activities of daily living, whether that be bathing, continence, dressing, eating, toileting, taking a crap, or transferring, or has a severe cognitive impairment. You also have the accelerated benefit rider for critical illness, which is for eligible insureds that experience a critical illness described in the rider after the issue date. Covered critical illnesses may be found in the rider forms. So what does this mean? You can actually take a living benefit from your term policy. Old term policies where you pay the money Your beneficiary gets the money when you die. Now you can actually add riders to your term policy, so you'll be able to benefit from having that term policy while you're still alive. Unfortunately, you have to be sick to get the money, but it's better to have the money when you're sick than not to have any money when you're sick, because medical bills are insane. So I have a personal testimony. Um, a lot of you might remember the dot-com crash back in 2000, 2001. During that time, I was a day trader, a very good one, and I was very good at making money very fast. My issue, however, was as much as I made the money, as much as I saved, I didn't do a very great job of protecting my money. So you can imagine when we had the dot-com crash, I lost a considerable amount of money, and it took me a long time to recover from that. A few years goes by, and then 2008 happens when we have the real estate market bubble burst, and pretty much everyone whose 401ks, mine included, everything dropped anywhere between 45 to 50%. Their portfolios, their savings, everything just tanked. And a lot of you might not know this about me, but I am a father. I have 3 children. I'm even a grandfather now, and I prided myself on being able to take care of my family, or doing everything that I can to make sure I provided for my family. And there were challenges during times. There were low years, but I really prided myself on doing everything that it took to make sure I provided for my family. So when I lost that money in 2000, and I lost that money in 2008, and of course I lost jobs and businesses and savings, everything, that much loss was devastating to me. So it really, really changed my sense of urgency early on. And it was a struggle to try to get back on my feet and try to get things going. So, you fast forward to when I finally got myself life insurance. The reason why this is such a big deal to me is, if I were to pass on, it's not an if, it's when. Your mortality is 100%. When I pass on, if I have my children, my grandchildren, my loved ones, someday my wife, um, they're taken care of. And that's a big deal to me. Being able to make sure my family is taken care of is the primary, paramount reason why, from my position, I exist. If I can't provide for my family, then why am I here? So I'm really excited that this opportunity has been made available to me, and that's why I'm so passionate about making sure this information is being shared with each of you. So I hope this information that I shared with you today will benefit you, or give you just a little bit more knowledge and a little bit more desire or interest to get out there and see exactly um, what opportunities are there for you to protect yourself and your family, your legacy, your assets. Of course, you have a particular situation, so you want to definitely go ahead and give me a call or shoot me a message. If you have any questions or comments, of course, you can leave those questions and comments in the comment section of the YouTube video, or in social media, wherever this video is posted. If you have any particular questions and you want to contact me directly, of course, you can give me a call directly on my cell phone, or shoot me an email with the information there on the bottom left. And as always, I thank you so much for your time. I really appreciate you taking the time to listen to this information, to view this information, but I'm hoping you share it. I'm hoping you talk to others and tell others that there is information out there to help you be more financially educated and more financially strong, because that is what's going to help us as a community to grow. And with that, I'm going to say have a fantastic day, and God bless you all. And again, thank you and good night.